Have you ever used covered calls or know a covered call strategy? In today's video, we're going to be reviewing what a covered call is because I had to understand this myself, and also looking at two new ETFs that are from Roundhill that I want to check out and that I am invested in right now. Now, this was a discussion that I had with my financial advisor talking about covered calls and understanding exactly what it is. So let's take a look at this. And I hopped over on Seeking Alpha, covering calls for beginners. Now, me personally, we are not doing the cover calls, so this doesn't apply in its entirety, but the cover calls are actually done through the ETF, and the ETF has done incredibly well over the past year since it has been, I believe it was March of 24 when they started doing these cover call ETFs, which we'll look at in just a minute. But when you think of a covered call, what exactly is it? It is an option strategy used by traders to produce income. So very similar to what we see with the income-driven ETFs, this produces income on stocks, on long stocks held in the position. So this is looking to make income. And both of these ETFs are going to reward you with income based on the covered calls, and they are going to reward you on a weekly basis. Now, my strategy here is being able to margin an investment portfolio at a very low interest rate and generate income from the covered call, which is well over what we're paying essentially for the interest income that we have. So far, it's worked incredibly well. We paid about $70 in interest in 1 month. We earned about $200 with the covered call strategy. So net, we're up about $130. And I've been starting to track this on an Excel spreadsheet. But looking at this strategy can provide income to a trader who is long-term bullish on stocks, doesn't believe there will be a significant increase in price immediately. Now, the calls that we're looking at are 0 day, meaning they are only out there for a day. At the end of the day, the covered call is going to be sold, which is pretty interesting. Again, we kind of broke this down, and looking at this strategy, it is pretty interesting. So let's look over at these ETFs. Now, right here, this is the first one. Now, you'll notice this is the XDTE S&P 500 0-day covered call strategy. So very interesting. Like I said, this uses the S&P 500 from Roundhill. And this, of course, S&P 500 is something everybody knows. It is the index that a lot of people do track. You'll notice distribution rate right on the side is 64%, 30-day SEC yield minus 0.53. So overall, covered call strategy is the first ETF to utilize 0 day to expiration, the 0 DTE options on the S&P 500, seeking to provide overnight exposure to that S&P 500 and generate income each morning by selling out of the money over or the 0 DTE calls on the index. It's an actively managed fund. So there is, of course, going to be a high and a much higher premium on this when it comes to what it holds. But you can see why the XDTE seeks to pay weekly distribution sold out of options. So these have been generating about $20 to $30 a week. Now, of course, I don't have a crazy amount. I believe I have about $5,000 invested in here, but overall, it's been generating some pretty good returns. And again, I'm hoping this strategy long-term will work incredibly well. It is generated through the cover call strategy of the S&P 500, and that it sells the 0 DTE options on the S&P 500, seeking to exploit structural market misprices. So again, the fund is currently expects but does not guarantee distributions on a weekly basis. So of course, all of the legal stuff that we see in there. But looking down here, the expense ratio. This is one that we always talk about. This one actually does have a pretty high expense ratio than what we normally see looking at our S&P 500 funds and a lot of those. Now, this, of course, the reason for this is when you start thinking of like a mutual fund or when you think of a larger fund that is actively managed. This is not just tracking the S&P 500. This is not tracking an index where it is very, very passive. This is actively managed on a regular basis by a couple individuals that have way more financial knowledge than I do. When we start looking at our top holdings, you can see they're kind of different. This is broke off because of the different, it's not a ticker symbol or a company. It's a different set of holdings that they have within here. And then looking at the performance. So this is kind of interesting. So $50 right here was the closing price. So it was down a little bit, and we've seen it since inception. It's up 17%. Now, of course, this is since inception as of 12/31/24. So last year it experienced about 9 months, because I believe, again, this was this ETF came out like March, I think it was March of 24. So they are both relatively new, which again, we have to see exactly what it looks like longevity wise. But you can see we have a 17.79% since inception, and distributions are coming out, like we said, every weekly at a distribution rate of 26.44%. So distribution rate, pretty solid right there. And then of course, distributions, you can see we're getting them on a weekly basis, which is pretty cool. It's a weekly paycheck. So when you think of your regular 9 to 5 and you're getting a weekly paycheck, even here, again, getting a weekly paycheck all of the time is pretty cool. Even looking at distributions. And again, this I believe was about the inception, which we said March. But looking at some of these distributions, 64 cents, 60 cents, 33 cents, 18 cents. So looking at some of the larger distributions, you figure for a ETF that costs $50 and you're getting 64 cents back, and that's on a weekly basis based on what you hold, distributions on here are pretty good. And again, what I'm doing with this is we are putting all of the distributions into an account. That account is used to repay what we borrowed on margin, and we're going to rinse and repeat until we get that margin paid off. Once it's paid off, we can actually borrow on margin again and just start getting this and really producing a lot more income. Now, there was a couple that was pretty low. Even here, we got 2 cents on this one. And again, but when you look at the actively managed, I mean, last year, they have a pretty good track record in there. Even looking right here. So why the DTE? Or excuse me, the QDTE, that's exactly what we're looking at. So the innovation, the zero TTE covered call strategy. And again, ticker symbol on this one right there, fund ticker is QDTE, but weekly distributions, income. And I want to show you kind of the illustration. This is for illustration purposes only, as you can see here. So market hours covered calls. This is where they're making their money. And then they're going long overnight. So overnight, it is long only. That is the only thing they're looking to do. They are going long. In the morning, they sell out of the position. So they sell everything. That is where the 0 day comes from, is they will place the positions. You can see right here, covered call position at 47. The long is at 50. Stock price is at 55. Then, of course, the next day, they are selling out in the entirety. Each day, trading day, the fund will sell a covered call against its position in the index, seeking to generate option income. Daily returns are capped at the sold strike, which of course is the sold strike over here. And then during the overnight session, the fund will no longer hold any option positions, resulting in full exposure to the index. So again, we are not holding things for days. Most of the time when you get cover calls, you hold them for a certain amount of time. This is not doing it. This is selling out of the position every single day, like we talked about. And then, of course, looking since the inception, 3/7/24, it's about 17.5%. So again, a little bit of underperforming what we see with the S&P 500 over the last 2 years, but overall, the generation of income is what we're looking for out of this one. Now, the second one that I've invested in is actually the QDTE. So it's not the zero DTE or the XDTE. This is the Innovation 100. So versus going in and doing the longs, or essentially the covered calls on that S&P 500, we are doing this on the Innovation 100. And looking at the distribution rate on this one, 24.55%. So we are almost seeing a 25% distribution rate in here, which of course is really good for the options. Again, 0 days. So it's essentially the exact same ETF that we were looking at, but this is on the side of the Innovation 100 fund versus being in that S&P 500. And even looking down here at the performance, you can see same, very similar expense ratio, very similar launch date. Well, same launch date, honestly. Again, it's kind of got some of the same holdings in there. And then the performance overall, this one is a little bit cheaper versus being $50 for the S&P 500. This one's at 39. We're seeing, again, a little bit of a change in here, but since inception, 17, almost 18%, which is a pretty good return. Then we look at distributions again on a weekly basis, 24.55%. And then we start looking down here at the history, which the last 12 months, and I think it'll show it in here. So even right here, so 23 cents, 18 cents, 24, 33, 18. So every single week when you're holding this ETF, you are seeing these distributions being paid, which again, the strategy of borrowing to actually repay is what we're doing on margin. Now on margin, we are paying, I think it's 4.5%, which again, through M1 Finance with the portfolio we have. So it's relatively cheap when it comes to borrowing the money over there. And then of course, this is the actual sheet, the tier sheet of the fact sheet, weekly distributions. And of course, and I think I might've had those two backwards. I think this one might have been the QDTE. So these two are actually swapped. I apologize for that. And then, of course, this was the second one in there. But again, very similar when it comes to both of these, just tracking two different markets, one being the innovation and then one, of course, being the S&P 500. But I want to update you guys every week or two on what the covered calls are looking at and how the income generation is really looking at of these. Because essentially, like I said, if we can get to the point where these are generating enough income, which I know short-term holdings with the distributions, we are going to have to pay taxes on. But if we can get to the point of paying down a little of that margin, of course, that margin is going to get infinitely cheaper as we're paying it down on a weekly basis. Because of course, every time that I make a payment, I can literally see the adjustments go down for how much interest we owe for the month. So again, if we can knock it out with some of these covered call strategies, being able to generate income to pay that down faster is going to make a big difference. But all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.